Kia ora koutou, welcome to Shared Lunch, brought to you by Sharesies. I'm Garth Bray, and this week I'm speaking with Tony Alexander, the perfect person to get a forward picture on interest rates, not just here, but on the other side of the Tasman in Australia, where the Reserve Bank of Australia has just made a big call on cash rates. Tony also has some pretty interesting reckons on the property market. All of that after you take note of some important information you should always consider before investing.
Investing involves risk. You might lose the money you start with. We recommend talking to a licensed financial advisor. We also recommend reading product disclosure documents before deciding to invest. Everything you're about to see and hear is current at the time of recording.
G'day Tony, you're there at Broadbeach. You're making the most of the Gold Coast?
On the Gold Coast, yes. Yeah, it's not sunny today. No point turning the camera around and showing you outside today.
You are best placed, I would say, to give us a ringside seat, not only into what's happening here, but into the Australian economy. And we are at this position where perhaps later today from where we're recording this, certainly by the time we're putting this out, we'll know whether one of the first major central banks is increasing rates again for the first time in a long time, yeah?
Yeah, basically that's the case. I mean, if the Reserve Bank of Australia hasn't increased interest rates by the time people will know that this gets played out there in the public, and then it's going to be next month or the month after, because what's happened in Australia is that the economy's growth rate, 2.1%, it's not necessarily anything too major, unless you compare with New Zealand at minus 0.5%. But it's the Reserve Bank of Australia's assumptions about the availability of capacity, especially in the labour market, which have proved wrong. They thought the unemployment rate was going to be much higher than it is. It's recently just declined to 4.1%. And so that means extra wages pressure is likely to come through. And already we've seen the inflation rate turning out higher than expected, 3.8% they're sitting at in Australia, with an expectation of a good economic outlook for here, consumer spending looking pretty robust, lots of residential construction activity, lots of investment in the renewable sector, data centres, and infrastructure generally out there. So the general discussion is the Reserve Bank of Australia, frankly, probably shouldn't have cut interest rates last year, and now they're going to have to reverse that. And guessing the speed is a bit of a dog's breakfast whenever you're at this point with a central bank, but they're going up.
The 3.8 inflation figure was a particular surprise. And I guess the reason I say we're talking about Australia so much is because our two economies are not just physically close, but, you could imagine that there's some tandem movements there. I'd be interested in your thoughts about how strong that correlation is and to what degree what we're seeing there may be mirrored in here. Certainly we're seeing a lot of that same sticky inflation. But that 3.8% inflation at the last print, really for Australia, that's almost a casting vote, isn't it, in favour of an end of a start of a new tightening cycle in interest rates there?
Yeah, it's not just that. Like I say, it's the low unemployment rate, but it's also the intransigence of the federal government with regard to ever increasing their spending. The federal treasurer keeps saying, no, the increase in inflation, etc., cost of living, nothing to do with the government. We're allocating money, blah, blah, blah. But the fact is they are increasing their spending pretty strongly, and that is, by definition, adding to inflationary pressures and making the job for the Reserve Bank relatively hard. And people are thinking, well, maybe they sort of cut interest rates last year when they shouldn't have, because they were sort of doing the government a favour and buying into their line. But, the problem is that they are increasing government spending. And this is an area where it does differ for New Zealand. I've already mentioned that our growth rate, well, recently for New Zealand, it's been negative year on year versus the plus 2.1% for Australia. Our unemployment rate is 5.3% versus their 4.1%. We've got Minister of Finance in New Zealand looking to restrain government spending after 6 years of blowout under Labor versus it's a Labor government in Australia. So they're actively blowing out their spending at the moment. And so things are not marching sort of one for one there in that regard. And this manifests itself mainly in the exchange rate. We had a period of about 12 years where the Kiwi against the Aussie dollar was pretty much always something like 90 cents through to 96 cents. Now we sit down at around about 86 point something, and that's because we've had this divergent movement in interest rates where the interest rates have gone down a long way in New Zealand. The cash rate is 2.25% and Australia is at 3.6%, maybe higher by now. And that is not the usual situation. Usually New Zealand's rate is slightly above Australia. Australia's. And so now we might be looking in the very short term at an extra widening of that. So there could be some interesting Kiwi-Aussie exchange rate movements in the very near future.
Yeah, we've been struggling to punch through sort of 87 cents, and it doesn't look like it's going to go anywhere near that, does it?
No, in the short term, assuming the Australian interest rates are going up, then that's the situation. The Kiwi dollar, maybe for the next 2 years, is going to remain relatively low and returning to that old 90 to 96 range. It could be a wee while before we'll get back there, but I think we will, because at some stage the monetary policies will be moving differently, and this is where it gets interesting. You see, for New Zealand, of course, the monetary policy framework pretty much the same as Australia. They're aiming for something between lower than 3%. And they've failed at 3.1% at the moment. But the tendency for our central bank has been, when it comes to seeing what's happening in the economy and inflation and doing something about it, they tighten too late, then they tighten too much. Then they ease too late and they ease too much. And they're into they ease too much. I thought our cash rate last year would bottom out at 3%. Not 2.25%. They went too low. We're going to see an increase from our central bank sometime this year. What time? That's anyone's guess at the moment. But what the Australians do in the short term, I think, will have some relevance. It will make our central bank go, well, actually, maybe we should be a little bit cautious, because look at what they're having to do over there. And we've got an election year to stuff everything up and make extra uncertainty.
And I guess to the background of that, we've got a new Reserve Bank governor here, Anna Bremen, come in from Sweden. Only one vote on a committee of 6, but presumably that'll bring some fresh thinking around this. I think in interviews last year she was talking about how, look, the point of this is to have some kind of economic recovery as well as to maintain control of inflation, and that was sort of when she was talking about whether banks should be moving on rates and so on. So that'll muddy the picture too, won't it, Tony?
To a certain extent, yes. Will it break their tendency of, like I say, ease too late, then ease too much, etc., and vice versa on the tightening? Don't know. She's proved herself to be a little bit error prone so far with some of her commentary. Nothing major, I feel, but that may make her just take a slightly softer voice until she really gets a feel for how the place functions. I think a key problem for the Reserve Bank maybe is more in the economics department rather than the Monetary Policy Committee, where the economics department, I feel, might still be running on strong belief in their macroeconometric models of the New Zealand economy, which are turning out just to simply be wrong, quite frankly, and they're not picking what's happening in the economy, not picking what's happening with inflation. And the recent inflation rate of 3.1%, they had expected 2.7%. So, the decisions made by the Monetary Policy Committee are depending on the information supplied by the Economics Department, and that, I think, is where there are some issues, frankly.
The Reserve Bank of New Zealand will be getting into the thick of it right now with a decision sort of February 18. Presumably they've now got the packs in front of them to indicate what sort of decision they should be making. Probably, you imagine it's going to be a hold steady at this point, but they'll be giving some forward commentary. Or do you have a different view there based on what you've said about where they should have been already?
I don't see them changing the cash rate come later this month. I think they'll want to see a lot more information regarding how quickly capacity availability is diminishing in New Zealand. There, interestingly, by the time people get to see our video, there's going to be some fresh information on this from the December quarter employment numbers. In Australia, these things have turned out to be a lot stronger than they expected. And I've just got a feeling that in New Zealand, not so much yet in the December quarter numbers, but as we go through the year, I think the labour market in New Zealand could tighten up a lot more quickly than people are thinking. I think businesses will do some extra hiring, and when we look at the ANZ's Business Outlook survey, on average over the past 3 decades, a net 6% of businesses each month have said, I'm going to hire more people in the coming year. That's running at 22% at the moment. A month ago was 28%. Businesses are looking to hire people, and we already saw the number of hours worked in the economy in the September quarter rise 0.9%, and maybe it did that again. We'll know, we all know by now, as well. So I certainly don't think the Reserve Bank will feel there's enough ammunition to move as yet. And I don't even think they'll feel that they need to start signalling that a tightening is imminent as yet. I think they'll wait until May when they do a whole new set of economic forecasts, they do a whole new monetary policy statements. That is when I think we should pay a little bit more attention. Before then, I fully expect the wholesale interest rates, however, will be rising. That we'll see further increases in basically the 1, 5, 10-year wholesale interest rates, government bond yields, the swap rates that banks borrow at. And so the story for 2026 is going to be what we've already seen happening from 1 or 2 months ago, the fixed mortgage rates rising, not necessarily jumping sharply, but rising as the year goes by, because the next change in monetary policy in New Zealand is a tightening. We just don't know when.
That was really a story just before Christmas, wasn't it, where you saw suddenly, off the back of the last Reserve Bank decision, those longer term rates actually took off quite quickly because of the foreshadowing language that had come through from the bank about, when things were going to turn around. It's not the only part of that story, though, isn't it? There's some sort of, basically a bigger picture, the world affairs, the state of the US economy and other things that impact on those wholesale rates, aren't they?
Yeah, that's right. I mean, we've seen increases in interest rates in Japan, Australia, obviously, with their quick change in monetary policy view, the United States to some extent as well, concerns about US federal debt, about the role of the US currency in the world economy as a reserve currency, for instance, concerns of foreign investors selling US government bonds. And it's like our own domestic issues come on top of that. And so it's not just whatever's happening in New Zealand with monetary policy that is relevant to there. It is this other stuff overseas, which is, as you go further out the yield curve, further out from 1 year to 3 years and then 5 years, etc., when it really kicks in, what's happening overseas becomes very important to what happens with those longer term borrowing costs.
There's been a lot of data just recently about mortgage debt, home loans and activity there in the lead up to Christmas because of the huge numbers we saw. I think it was something like close to 6 billion, 5.8 billion worth of debt that swapped banks, people looking for better options. It was about sort of, close to 50% were on floating. It did feel like a real sort of turning point, and yet we're seeing a lot of people are still coming off rates, and the average rate is dropping, isn't it? So how is that going to feed into the picture, not just in the coming quarter, but in the coming year?
Yes, it's two divergent things. With the average interest rate is falling as people roll off something higher into something lower, that has its positive impact mainly in terms of consumer spending, going down to the shops, to the cafes, restaurants, domestic overseas travel. There's a positive stimulus going to run through our economy this year from the average interest rate falling, and it will lift the pace of economic growth alongside business investment, infrastructure, strong exports as well. With the anticipation of higher inflation maybe in New Zealand or the Reserve Bank tightening monetary policy, that's mainly relevant for the new borrowing which people are doing out there. For somebody looking to now go and buy a house who didn't already have one with a mortgage, for them the risk is the interest rate gets higher as each month or 2 month period goes by through 2026. And that's just one of the factors which will restrain the speed of upturn in the housing market this year. It's not going to stop it. I've seen some commentary out there saying, it's going up and now it's going to go back down again. No, I don't buy into that. Not with employment confidence picking up by people out there. But it just means we're not going to have any sort of housing boom. It's not going to be an exciting thing of we've got to get something as quickly as humanly possible. That's sort of gone for quite some time in New Zealand.
And with that, I guess, no recovery to prices in some of the areas where we've seen in real terms a 20 or a 30% drop since the peak back in sort of 21, 22 kind of thing. Obviously, that was maybe a little bit of an asset bubble we can now sort of see. But people are going to feel, unless they're in the right postcode, they're not going to feel that rich, are they?
That's right. There's not going to be all that much of a positive wealth effect coming through to the economy from, by crikey, I'm worth $200,000 more than I thought I was. Let's buy a new car. I mean, people do tend to overestimate the magnitude of that, but it is a positive magnitude. So that'll just be one source of restraint on the economy. So, economy up, but it's not a boom. Real estate market up, but definitely not a boom out there. There are just many restraining factors. The election obviously is going to be a restraining factor overall. From some point, maybe it's late winter, people are going to go, I'm just going to wait and see what happens. What will the new government be? What will the policy trade-offs be? It will tend to, stall some of the business investments, and so the upturn in the economy will just be dampened a little bit at that time, and maybe a little bit in the housing market as well, as people wonder, I wonder if there's monetary policy implications from whoever comes to power. Don't know. It's a usual thing. Happens every 3 years.
But immigration as well, that's another one of those main drivers in the past, or main indicators of how well the housing market is doing. Obviously, if you're bringing larger and larger numbers of people into the population, you're going to need somewhere to put them. And we can see that that's already quite a political football with the sort of commentary that's emerging around the India-New Zealand free trade deal and the pushback there. I mean, have you looked at immigration at all? Have you looked at the sort of the trends there and how that's likely to influence things?
Yeah, first point to note about immigration, it is impossible to forecast with accuracy net migration flows. I've tried this for 3.5 decades, cannot do it. I've seen others try it, come as badly unstuck as myself, so it's going to do whatever it's going to do. However, everyone likes a view, so when we look at the most recent months, we see that the annual net migration gain bottomed out, 6 or so months ago, had 8,500. Now it's running at about 10,500. So if you squint your eyes and hold your tongue just right, you could say, I think there's a slight recovery in the net migration flows, which is underway. Well, it's not convincing me yet, especially not with the still strong Australian economy, massive demand for labour in Australia as well. Net flow of Kiwis across there, I think, is going to remain relatively strong for a while. And I think clearly the government, outside of some slight easing on the with the trade agreement, India there, there's no big change in the migration policies are running through that's going to have a big impact there. The key thing maybe to note is that on average in the past decade, there has been a net migration gain of 50,000 people a year. We're running at 10,000. It's well below average. So we are going to have, I'd say through this year and 2027, below average stimulus to the residential real estate market and the economy from net migration flows, just below average. That's all I'm prepared to say.
And presumably that's going to flow through to their hiring conditions and available employment, and that's going to put another dampener on the ability of firms maybe to grow as quickly as they'd like to. And then we could be back into sort of an inflationary cycle as well as the sort of the wage bills go up, right? Because there aren't the people there to meet that capacity. Would you be fair there?
That's it in a nutshell. I think the assumptions businesses might have of, okay, when we need to grow, the people are going to be there. I think those assumptions are going to prove wrong because we've got not only young people with all their eagerness and the ability of a business to mould them, possibly disappearing to Australia. We do, of course, have evidence of their parents, the generation above them, also being concerned about what they see around them and going across to Australia or maybe somewhere else as well. And economies move in cycles, and when businesses see, the cycle is upward there, it's not massive, but it's upward, let's start catching up on our hiring. Let's not lay off the people we were going to lay off. And yeah, I do think the market could dry up relatively quickly. And the issue here from the Reserve Bank's point of view is that wages growth is still above average. So since 1992, on average, ordinary time average hourly earnings have grown 3.3% per year in the New Zealand economy. 3.9% is the latest growth rate. So even with the unemployment rate going recently from 3.3% to 5.3% approximately, and with all the woe in the economy, wages growth has still been above average. Wages growth has still exceeded increase in the cost of living over the past 5 and 6 years. So that will mean some extra inflationary pressure is going to come along unless we get surging productivity. Everyone embraces AI and productivity surges. Well, the evidence there is a little bit dubious, shall we say, so far. And for 3 years in a row, the data so far available in New Zealand for the past 3 years, the level, not the rate of growth, the level of productivity in New Zealand has fallen. That's really bad for inflation. It says that for any given rate of growth in your economy you see coming along, you've got to allow for higher inflation than if you were increasingly productive in your economy. Oh, and let's throw in there just from the inflation worries point of view, if people aren't scared enough already about interest rates rising at unknown speed this year, we are a country of many oligopolies and monopolies. Monopoly, one seller. Oligopoly, 2, 3, maybe up to 5 sellers. And so you look at sectors like electricity, insurance, aviation. Monopolies, councils. The only way you can escape your monopoly council and what they do with your rates is go live in another monopoly council's area. And this is an unfortunate dynamic for New Zealand. It means inflation can get relatively entrenched out there.
That's the structural part that really a rate cut doesn't do much to fix, right? It's beyond the reach because that stuff is usually moving at a much greater level, and it's not susceptible to a change in rates. Yeah.
Yep, that's right. In fact, even if we look at it, I think from a slightly different point of view, I think about 40% of the 649 items that make up the Consumer's Price Index are priced overseas, or their prices are determined by what's happening overseas. So only 60% of the items are really susceptible to monetary policy changes in New Zealand. And then, of course, a lot of them are determined by these large businesses. So the monetary policy really struggles to get things going. And there's one thing I haven't even mentioned yet, and this is actually a key thing I've been hammering since about August of 2024. So maybe some people remember in August 2024, I jumped up and down like an idiot saying, don't think 2025 is going to be a rock star economist like some journalist just said. And I hammered that and I hammered that. I had a second message, which I'd play every now and then, but I've been strengthening ever since about the middle of last year. And that was about underlying inflationary pressures. And what I repeatedly did was refer people to the ANZ Business Outlook survey, where one of the questions they asked businesses is, what do you plan doing with your selling prices for your products over the next 12 months? On average, since 1992, a net 26% of businesses each month have said, I'm going to raise my prices. So that's the normal, okay? 26% net saying, I'm going to put my prices up. 3 or 4 years ago, that peaked at 81%, fell to a net 35% in mid-2024. Then it's gone up, and the past 2 months has gone up to 51%, and now 57%. And a way to interpret that is basically a net 57% of businesses are saying, as soon as I get extra customers coming through my door, I'm rebuilding these margins, which have got crunched by higher costs in the past 3 to 4 years. That is where the Reserve Bank is also going to get some strong inflationary pressures coming through, businesses rebuilding their margins.
So that seems like if you are in the happy position of being one of those, I think it's 60-something percent, 68% of people that are coming off some kind of a fixed rate in the next year, and you're looking again, what are some of the things that you have to bear in mind when you're trying to pick the term and structure that loan? Obviously, as always, there will be individual circumstances, and people should not take this as personal advice. They should always get professional advice that's tailored to their situations. But what are some of those big things or big trends that you would maybe say, hey, do not disregard this, that influence what sort of term, what sort of structure you might want to put around things?
Yeah, that sort of commentary only, I think, has solidity at certain points in the cycle, as in only in about 10, maybe maximum, maybe 15% of a time period, let's say 5 or 10 years, would I say you should really pay attention, and this is what you have, maybe you want to consider structuring things. The rest of the time is just personal circumstances, your cash flows, this sort of thing. But for some times, I would jump out and say, you don't want to touch the long-term, the rates with a barge pole. I first wrote that in 1998, just because the 5-year fixed rate's here and the 1 year's up here. There's a reason the curve is like that. It's because the interest rates are going to plummet. The economy's headed into recession. Pay the high 1 year and then look to maybe fix lower sometimes else. I haven't had to say that for a while. My messages instead have been the other way around. For an 11-month period over 2020-21, I was saying to people, well, you can fix 1 year at 2.29% or 5 years at 2.99%. Hardly anyone went 5 years, but the reason I said 5 years was because we're not going to stay down at that level. Pandemic, deflation, worries, etc. And of course, rates are skyrocketed. And what I've been saying recently, from I guess late last year, was if I were a borrower, I personally would have been fixing 5 years at 4.99% because of the inflation risks I see. The 5-year rates are now around 5.29% and rising, and the 1-year rates are 4.5%. For most people, that's too big a jump to make. I'd find it difficult to recommend a friend or relative fix 5 years and sacrifice, 0.75% there. But if I were borrowing at the moment, I'd probably look at fixing 3 years and take me beyond, through this period, I think, of when the Reserve Bank is going to have a problem, late 26 and 2027. I personally would look for some security against that. The further we get through 2026, the closer we get to the point, and we're going to get there probably before the middle of the year, when there's no point trying to be clever about this whole thing. Just look for whatever rate is the lower and you're in for the ride. We're not yet at the point where I'm saying you missed the opportunity, you're in for the ride. I think there is still a window of opportunity to lock in some reasonable insurance against what the rates are going to do. But that could have gone before the middle of the year with increases in those 3 to 5 year rates further coming along.
But given what you were saying about prices and what we've sort of, you're not the only person, obviously. I think ANZ this week was sort of saying, or last week saying, hey, we see 2% house price growth in the next year. Maybe I think someone was saying 5% the following year. It's pretty flat. So really a lot of the price pressure has gone out of the market, right? So it's really around the cost of finance if you're looking to buy or treat property as an investment, yeah?
Okay, yeah. First of all, if we're talking about inflation, housing is a red herring. It's a contributor, but there's all this other stuff going into inflation. So even though we're going to have weak house prices growth, it doesn't change a single thing of my warning about an overall inflation, wages, profit margins for businesses, overseas inflation, all that sort of thing. When we're looking at the housing market, there are two key forces going in opposite directions this year, and I could already see it in the monthly survey I do of real estate agents. And those forces are job confidence and financing costs. And what we've got at the moment in my most recent survey, I've got a big increase in the proportion of agents saying people are worried about interest rates going up. So I think in early December, only 2% or so of agents were saying, oh, people are worried about interest rates going up. Now it's 20-something percent. But at the same time, we'll go to September was the peak. In September, 55% of real estate agents said, oh, people are worried about their jobs, about their incomes. That's now down at 33%. So one of these key things is going up, the interest rate restraint, but the job security thing, worries are going down, they're sort of crossing. And what that says to me is that, well, it's not going to stop the housing market going up this year just because interest rates edge up a little bit. People are going to be increasingly happy about their jobs. The wages growth is still going to be reasonable out there. The issue, I think, more maybe for the housing market is supply. There's a lot of supply coming forward. We've just seen the number of consents issued for new houses rising again. If we go back about 6 months, the annual number of consents was 33,600 or so. We're up to 36,600. And so there has been a structural shift in the rate of growth of new house supply in New Zealand, which is great. It's great for young buyers in particular. They're not all townhouses by any means, but this is a structural shift which the government is looking to accelerate further with extra rule changes. What does it add up to? It adds up to, I think house prices still rise this year, but the increases are going to be relatively small. That's what I'd say.
So look, if we're trying to sum all of this up then, what I'm hearing is obviously that there's a real turn of the tide coming there in Australia, but the forces that are pushing those tides are playing out differently here, and that we obviously, people need to pay close attention maybe to our own local picture more so than just tracking whatever the RBA is up to.
Yeah, that's right. Don't look for lockstep movements between the Reserve Bank of Australia and the Reserve Bank of New Zealand. I mean, we saw interest rates be cut in New Zealand from August 2024. The RBA didn't move until I think it was February of 2025. There's a broad correlation in the cycle, but it's not going lockstep month or quarter there. And if we're looking at the economies overall, there's a good outlook still for Australia's economy. There are a lot of forces underpinning growth across in the country there. But in New Zealand, we have also good underpinning for growth over 26-27 from the average interest rates at lower levels, farm incomes higher, residential construction rising, infrastructure spending from the government increasing, foreign students coming through into the country as well. There's a lot of stuff coming together, but it won't be a boom in the economy. There will be restraint from new borrowing interest rates slightly rising as the year goes by. The election year is going to maybe cause some businesses, etc., to just go nah and wait to see the outcome. And of course, the international situation is very uncertain. And so some businesses just at the edge may go, oh, I'll just wait a little bit longer and see exactly what happens with the global tariff situation, etc. And for the housing market, turnover definitely improving throughout the year, but not much action, of course, on the prices front, and a continuation of something I've been talking about for a while, and that is the growing absence of as many investors or people looking to invest in residential property as in the past. The people maybe who've never done it before, who might have thought about it in the past, now will not be thinking about it. And there's going to increasingly be people looking at other assets to invest in. They're not all going to be running off to gold and Bitcoin or silver or something like that, whatever is the flavor of the moment. But I do think with a change in the generations, the baby boomers, etc., found that property was working pretty well for them. Well, now they're becoming net sellers, of course, to fund expensive retirements. But for the younger people, they're going to be looking for, I think, a lot of other assets instead out there.
Tony Alexander, thanks for your time and your insights. And thanks to all of you for your attention, catching this on YouTube or Spotify or iHeart or on the Sharesies app, wherever you're getting the shared lunch. Kumatu, we're done for this week.